Every Canadian investor eventually asks themselves, how much risk do I really want to take? Do I go all in on stocks for maximum growth, or do I add bonds to smooth the ride a little bit? And this is where VGRO, the Vanguard Growth ETF portfolio, comes in. It's designed to give you strong long-term growth while still protecting you a little bit with a bond cushion. But here's a real question. Right now, is VGRO still the right balance between risk and reward? It's a good question. Stick around because by the end of this video, you'll know exactly what VGRO offers, what it doesn't, and whether it deserves a spot in your RRSP, TFSA, FHSA, or taxable accounts. So, why VGRO still matters? You're watching this because you care about your long-term investing. You want something simple, low-cost, and reliable. An ETF you can buy, hold, and let compound for decades without constantly tinkering with it. VGRO was built for exactly that. It's part of Vanguard's family of asset allocation ETFs, designed to give Canadian investors a one-stop solution for diversification. And in this day and age, it matters more than ever. Interest rates are stabilizing, bonds are regaining their role as portfolio stabilizers, and Canadian investors are looking for ways to grow wealth without riding the full roller coaster of an all-equity portfolio. But first, what is VGRO? VGRO is an asset allocation ETF that holds roughly 80% stocks and 20% bonds. That mix changes the entire experience of an investor. The stocks drive long-term growth, absolutely, but the bonds smooth volatility, soften crashes, and help your portfolio recover faster. It's globally diversified with exposure to Canadian equities, US equities, international developed markets, as well as emerging markets, and global bonds. You're not just betting on one country or one sector. You're pretty much spread across the entire world. Think of VGRO as a growth portfolio designed for investors who want strong returns, but also want to sleep at night. So why do investors like VGRO? Let me clarify, VGRO's strengths are very clear. It's a simple one ETF, one ticker, instant diversification. It's a cost-effective ETF with management fees of around 0.24%. It's also globally diversified, giving you exposure to thousands of companies and bonds across multiple markets. And trust me, it's emotionally easier to hold during a downturn because that 20% bond allocation cushions the blow during downturns. For investors who want growth but don't want to panic every time the market dips, VGRO is one of the most practical solutions available. However, it has its downsides as well. VGRO isn't perfect. The bond allocation means your long-term returns will be slightly lower than an all-equity ETF like XEQT or VEQT. You're trading maximum growth for a little bit of comfort. And while 20% bonds help you during crashes, they can feel like a drag during bull markets when stocks are soaring. VGRO also has a Canadian tilt, meaning you'll see more exposure to Canadian equities than a purely global fund. That's good for home bias, but it can limit diversification a little bit compared to a world market approach. And let's look at some real-life example. Imagine two investors. Let's say Alex chooses XEQT and Jordan chooses VGRO. The market drops 20%. Alex sees their portfolio fall sharply and they really start questioning their entire strategy. Jordan sees a smaller drop, still a drop, but they feel more comfortable and stay invested. Fast forward 10 years. Alex might potentially have high returns on paper, but only if they stayed disciplined through every single downturn and didn't sell. And Jordan, on the other hand, might have a slightly lower return, but because they stayed invested through every single downturn throughout the 10 years or 20 years, they actually end up ahead at times of investors who panicked and sold. And this is why VGRO matters. It's not just about numbers, it's about behavior. So let's talk about the fees now. VGRO charges you around 0.24%. That's still incredibly low compared to mutual funds, for example, which often charge 2% or more. Over decades, that difference compounds into thousands of dollars saved. The fee is slightly higher than XEQT or VEQT, but I would say the difference is really negligible, especially if you're comparing it to the comfort that VGRO provides. So, who should choose VGRO? I would say VGRO is best for investors who want strong growth, but also want a smoother ride over long term. It's for people with a medium to long time horizons who know that they might panic during big drops and who want some bonds to soften the emotional roller coaster, as well as those who prefer consistency over maximum returns. If comfort and stability help you stay invested, VGRO is the better long-term match. So to summarize, VGRO is one of the simplest, most balanced ETF solutions for Canadian investors. It gives you growth with a safety net, making it much easier to stay invested, especially through the tough periods that derail most people. It's not perfect. You'll give up a little bit of long-term return potential compared to an all-equity ETF. However, if VGRO helps you stay invested and on the course, it will likely make you wealthier than choosing a maximum growth and bailing out at the worst moment when the market tanks. Think of VGRO as a cruise ship of investing. It might not be the fastest or the coolest, but it's pretty steady, reliable, and built to carry you through the storms. Anyways, guys, thank you so much for watching. If you made it this far, you're already ahead of most investors who never take time to understand their own risk tolerance. If you enjoyed this breakdown, hit the subscribe button. It tells YouTube my videos are at least halfway watchable, and honestly, that's all I'm aiming for. And as always, this video is not financial advice. I'm here solely to give you information, not tell you what to buy. Anyways, thank you for watching and see you in the next one. Take care.